If you're a first-time homebuyer and somebody mentioned that you should get an FHA loan, stick around. This video is for you. An FHA loan is a great option for somebody that wants to buy a house without having to put an arm and a leg down for a down payment. But there are some drawbacks to the loan itself. My name is Chilton. I'm a mortgage broker here in Austin, Texas. Let's do a deep dive on what an FHA loan is, who it's for, and who it may not be for. Now, to start out, FHA stands for Federal Housing Administration. The loan is backed by the government. In case you default, the lender that gives you the FHA loan get a portion of the loan amount back. It backs them up a little bit. Now, the first misconception about an FHA loan is actually what I mentioned in the beginning, is that it's only for first-time homebuyers. Although it's a great loan for people that are first-time homebuyers with slightly lower credit scores, you can actually get an FHA loan even if you've owned properties in the past. The only time you can't get an FHA loan is if you currently have an FHA loan on a property that is 100 miles or less than the new property that you want to buy. But let's say you own a property, you're about to sell it, it has an FHA loan on it, and you're getting another house to either increase the size of the house or your family's growing, something like that, then you're good. Let's go through some of the positives of FHA loans and also some of the negatives. The biggest positive of an FHA loan is that you need to only put 3.5% down for the down payment, as opposed to 5% or more on a conventional. This can be a huge help for people that don't have a lot of cash on hand, or just people that don't want to deplete all their cash reserves. Another positive of FHA loans is that it requires a lower credit score to qualify. For example, the standard minimum credit score for an FHA loan is 580. There are scenarios where you can get down to 500 on your credit score, but you'll need at least 10% down for that scenario. But 580 and above, you're good with 3.5% down. If you've had some issues in the past with credit, or you just don't have enough credit to build up, this may be a good loan for you. Number 3, FHA loans are a little bit more lenient when it comes to debt to income ratios. Conventional or even jumbo loans are actually very strict on how much the debt to income ratio can go up to, but FHA loans are a little bit better. And speaking of credit, FHA loans are a little bit more forgiving if you've had a bankruptcy in the past or foreclosure. With a conventional loan, you have to wait twice the time to have that clear off your credit before you can qualify, whereas FHA, you can do it a little bit quicker. Another positive is that the interest rate is typically lower on an FHA loan as opposed to a conventional loan. But you always want to look at what's called the blended interest rate, which is the interest rate plus the MIP, because that's where the truth lies. One of my personal favorites, which is a huge positive, is that you can do what's called a streamlined refinance. Now, this also applies to VA and USDA loans, but a streamlined refinance, you don't have to order another appraisal. You don't have to show proof of income. The only documents you're really going to need are going to be your mortgage statement, your homeowner's insurance, and HOA if you have one. Okay, sounds great so far, but what are the negatives? Well, first and foremost, the closing costs are going to be a little bit more expensive, or a good chunk more expensive than a conventional loan, because you have to worry about something called the UFMIP, or the upfront mortgage insurance premium. That is going to be based on 1.75% of the loan amount. But don't worry, it's not going to be 3.5% for the down payment plus the 1.75% for the UFMIP. Those are combined together. And speaking of UFMIP, when you get an FHA loan, you get what's called a mortgage insurance premium. It's pretty similar to PMI, or private mortgage insurance, on conventional loans. The letters are rearranged a little bit, but you're actually going to be paying more on the MIP. A thing to note with the MIP on an FHA loan is that if you put less than 10% down on the house, the MIP is going to stick around for the life of the loan. If you put more than 10% down on the house, it'll fall off in 11 years. But that doesn't mean you're going to be stuck with a loan for all that time with the MIP. Here's the secret. If you bought a house with an FHA loan with less than 10% down, you're not stuck with that loan forever. You can actually refinance into a conventional loan, especially if you got into this house with a lower credit score. Once your credit score bumps up, refinance into a conventional loan. That way your MIP is not going to be there for the life of the loan. Another negative of an FHA loan is that there are currently loan limits for how much you can borrow. For example, as of now, it's around $571,000 as opposed to a conventional loan, which goes up to $726,000. So this may make it a little bit difficult to buy homes in certain areas, but still gives you a lot of flexibility. Negative number 3, the appraisal is going to be a little bit more stringent than a conventional loan. If the house has peeling paint or cracked windows or different things like that, you're going to have to fix those before the loan can close. Luckily, most issues that you see on an FHA appraisal are very easy to fix, cost a couple $100, and you get it reappraised and you're good to go. It's important to know that everyone's financial situation is different, so what may be positive for one person may be negative for another. I always urge people to talk to a loan officer or a broker like myself, shameless plug, but that way you understand what you qualify for, what your options are, and you make the best move possible for you. Do me a huge favor, please like this, comment, and subscribe if this was helpful, and share this with someone, and I'll see you later.